We've got Mr. Ehsan Saeed of Fitch Ratings joining us now on the show to talk to us about the report that Fitch has really put out on the NBFC sector. Now, Ehsan, to begin with, you've maintained a stable but cautious outlook on the major Indian NBFCs for the year 2012. Could you tell us what the business outlook is for these NBFCs and what the concerns for you are?
Okay, well, the concerns as we have highlighted is one is there's going to be a cyclical impact from the moderating economic growth and continued high interest rates, which will have an impact on the asset quality. Then the other point is, of course, the regulatory changes. Some of these are proposed and, some of it is already implemented and some is what we call potential changes in regulations. As we highlighted in our report also, the guidelines implemented from 1st April, which excludes the bank lending to NBFCs from the priority sector criteria. That's obviously having an impact on the cost of funding costs of the NBFCs across the board. So this is one impact coming together with the increase in credit costs that we expect to increase across the board. And the third is the various committees which overall as a credit rating agency we do take positively the strengthening regulation. But obviously there would be an impact on the profitability and that would in turn impact the cost of raising capital for these NBFCs, major ones as well.
Sure, but Ehsan, while the regulatory environment changing for NBFCs clearly is a concern, why would you list out credit costs or rather high credit costs as a concern? Because we are at the top of the rate cycle, the cycle is going to turn and that should in a sense benefit NBFCs. One of the key asset classes for these NBFCs, as we highlighted in the report also, is the heavy and medium commercial vehicles. And based on our study of the correlation of the sales of these vehicles with the IIP, and then in turn the correlation of the IIP, like the Index of Industrial Production with the repo rates. So we see there's always a lag. So even if the interest rates start to, as the market expects, start to come down in coming few months, there would be a lag of several months for this key asset class, to pick up. And that's why we think the credit costs will remain high. And at the same time, the growth in this key, asset class will also be low or maybe just flat. So that's a key asset class. And besides these, we have the construction equipment financing and also loans against property and small business loans at some of the NBFCs where we remain negative.
Ehsan, afternoon. Avan joining into the discussion. Now, you listed out a few of the concerns, regulatory changes as we just spoke about, the funding access worsening as well as profitability under pressure. But would you say that amongst these as well as the asset quality deterioration, that would be one of the biggest concerns given the cyclical headwinds? That would affect the asset quality, which in turn would slow down the loan growth for most of these companies.
This is a cyclical factor and basically we have factored it in. I mean, if you look at the risk-adjusted margins that these NBFCs charge, obviously they're taking higher risk. I don't think this is a game changer, but of course this is a cyclical factor which will increase the credit cost, but this is not a game changer in the medium term. As the economy again grows, interest rate cycle turns, gradually in the medium term, this is not a large concern for us.
Sure. Again, Ehsan, you've got scores of NBFCs dotted across the country. Now, with regulatory changes coming into force, what are you seeing? Do you expect to see a large-scale consolidation in the sector, or would you say that many of the very small players are just going to vanish?
I mean, that's, coming to your last point, the smaller players, there would be a consolidation at that segment. There is bound to be. I mean, the regulations, up about increased asset sizes and increased net worth requirements would in itself lead to consolidation in that segment. Now, on the larger ones, larger NBFCs,
in the market, they're 12,409 as of June. But if you look at the larger ones, they're just 550, which includes the deposit taking and the non-deposit taking systematically important ones. I think in that there would be probably the 100 bigger ones, or let's say 150 bigger ones. They are going to be impacted. Their profitability is going to be impacted. But a huge impact in terms of consolidation or these companies disappearing is unlikely.
Sure. Also, as per the report, you're saying that Fitch expects the heavy and medium commercial vehicle financing to remain the weakest in 2012. Could you just run us through the rationale for the same?
I think I explained it earlier as I, talked of the correlation study that we have done between the sales of the heavy and medium commercial vehicles and the index of industrial production. And there has been a positive correlation. And IAP, in turn, we've done another study with the repo rate. There is a negative correlation. So even if we're now at the end of February, so even if the repo rates start to go down from the middle of the year and gradually these, there will be, let's say, as in accordance with market expectation and the signals from the central bank that the rates will start coming down, there would be a lag of 3 to 6 months before the index of industrial production starts to pick up, and in turn the sales of the heavy and medium commercial vehicles will start to pick up. Because again, coming to the NBFCs, their customers are small road transport operators, individual drivers, and those folks are exposed to a lot of uncertainty, and unless the real change in industrial production is visible, these guys would not go out and start to take loans again or incremental loans or new loans. So that's why we are kind of negative for this this segment, the key segment for most of 2012.
Sure. Ehsan, now you haven't really painted a very pretty picture for the outlook for NBFCs in 2012. But what factors should we expect will change your outlook on NBFCs going forward?
Well, I mean, there are, as I said, there are I'll say 3 factors out here. One is the cyclical impact on the credit cost, which if the economy turns down, if it turns around, if there's not a large deterioration, then this should take care of the credit cost from the later half of this year and early part of next year. The second thing is about funding costs. Funding costs, again, this is linked to regulations, the third point, which is the priority sector lending, which was a key channel for the NBFCs, that has basically from the start of this year been closed. So now we had another committee which has recommended that on selected basis and based on increased due diligence, the bank lending to NBFCs, I mean, there are all kinds of conditions, could be considered as priority sector. Now, depending on how soon this recommendation and in what form this is finally implemented, this could have an impact on the funding cost. So regulatory changes, obviously, are one of the major factors besides the cyclical factor. So we will have to see, as I said earlier, if the economy again starts, the GDP growth starts to grow, increase, and in turn the IIP starts to increase, that would change overall sentiment for the key asset classes that the NBFCs serve. And depending on the regulatory changes, which overall we think, from credit perspective are positive. So this can change the outlook.